Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing jargon into plain English. And today we're diving into a financial report that's like staring at a very, very long list of money going in and out. It's all about how much cash is being managed by Fidelity's Government Cash Reserves Fund. And trust me, when we talk about managing cash, we're talking about big, big numbers. So what exactly is this fund up to? Think of it as a super safe place for a huge amount of money, like giant piles of cash that big institutions might not need right away. This report covers the 6 months ending May 31st, 2025. Let's peek at where the money is actually going. The fund is all about short-term safe investments. We see that about 78.4% of the fund's assets are in investments that mature in 1 to 7 days. That's incredibly short-term, meaning the money is constantly being rolled over into new, very safe, very short investments. A massive chunk, 52.2% of the fund's assets, is in something called repurchase agreements. Now, don't let the fancy name scare you. Think of a repurchase agreement or repo as a short-term loan where somebody sells you a security like a treasury bond and agrees to buy it back later at a slightly higher price. It's a way to make a little interest on cash you're holding. Many of these are backed by US government debt, which is about as safe as it gets. We see many of these agreements with counterparties like Bank of America NA, Citigroup Global Capital Markets Inc., and JP Morgan Securities LLC. Another big piece, 35.3%, is in US government agency debt. This includes things like bonds issued by Fannie Mae and Freddie Mac. These are generally considered very safe, though slightly less safe than direct US Treasury debt. The report lists hundreds of these specific investments with maturities ranging from a few days to over 180 days. It's a detailed look at the fund's short-term lending to these government-backed entities. Finally, there's 13.4% in US Treasury obligations. This is the gold standard of safety, direct debt from the US government. Again, the schedules show hundreds of these too, mostly Treasury bills and notes with various interest rates and maturity dates. It's a vast portfolio, really illustrating the scale of this fund. Now let's look at the big picture statement of assets and liabilities as of May 31st, 2025. The fund holds a staggering $228 billion in investments. That's 228 followed by 9 zeros. And its total assets are even higher, over $232 expenses. This leaves the fund with net assets of over $226 billion. That's a massive amount of money being managed. The important thing to note here is that the net asset value per share is $1.00. This is typical for money market funds where the goal is to maintain a stable share price. Looking at the statement of operations for the 6 months ending May 31st, 2025, we see a huge amount of income generated from investments. The fund earned over $5.2 billion in interest income alone. After paying out expenses which include management fees, custodian fees, and registration fees, the net investment income for the period was close to $4.8 billion. When we look at the statement of changes in net assets, we see the fund distributed almost $4.8 billion to shareholders over these 6 months. Despite these distributions, the fund's net assets actually decreased slightly from just over $200 to $235 billion at the start of the period to about $220 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over $633 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over $630 billion. But redemptions were even higher at over 630 directions. Where people took money out of the fund, we see that the proceeds from share sales were massive, over $600 billion. But redemptions were even. Let's dive into the financial highlights. It shows us how the share price and returns have performed. And here's the really interesting part for a fund like this. For the selected years, the net asset value per share has consistently been $1.00. For the 6 months ending May 31, 2025, the net investment income was about $0.224 per share. The total return for the 6-month period was 2.05%. For the full year 2024, it was 5.02%. And in 2023, it was 4.67%. These might seem like small numbers, but remember, this is for a fund designed to be incredibly safe. Earning a few percent on hundreds of billions of dollars is a massive amount of money. Now, about the fees. The expenses before reductions for the 6 months were 0.37% annualized. This means for every $10,000 invested, investors paid about 37s over the 6 months. This is a very low expense ratio, especially for a fund managing such a vast sum. The notes to the financial statements clarify that the fund values its securities at amortized cost, which approximates fair value for these types of short-term, high-quality investments. They also mention a deferred compensation plan for trustees and the fund's intention to qualify as a regulated investment company, meaning it distributes most of its taxable income and gains. This section talks about taxes. The good news for investors in this fund is that it's structured to avoid paying US federal income taxes by distributing most of its earnings. This means the tax burden is passed on to the shareholders, who will then pay taxes on the income they receive. For the period, the fund had some capital loss carryforwards, which are basically losses that can be used to offset future gains, but these are relatively small. Let's look at the management fee. Fidelity Management and Research Company LLC charges a fee for managing this massive fund. The maximum basic fee rate is 0.27%. However, the report details that the total annualized management fee rate, including an income-related fee, came in at 0.37%. This covers services like investment management, and it's a very competitive rate for such a large fund. Now, looking at these results more broadly, Fidelity's Government Cash Reserves Fund is performing exactly as expected for a money market fund. It's generating stable, albeit modest, returns by investing in very safe, short-term government and agency debt. The sheer scale of the fund, managing over 22.6 billion tokens, is remarkable. The strategy is clearly focused on capital preservation and liquidity, which it achieves by holding a vast portfolio of short-dated, high-quality securities. The main risk, as always with money market funds, is a sharp rise in interest rates that could cause the fund's value to drop if it can't roll over investments fast enough or if it holds longer dated assets. However, given the fund's extremely short-term focus, this risk is minimized. The outflows in share transactions where redemptions exceeded sales might indicate a slight flight to safety from investors or perhaps a reallocation of assets, but the fund's stability remains. The low expense ratio is definitely a strength, maximizing returns for investors, or perhaps a reallocation of assets, but the fund's stability remains. The low expense ratio is definitely a strength, maximizing returns for investors. Or perhaps a reallocation of assets, but the fund's stability remains. The low expense ratio is definitely a strength, maximizing returns for investors. Alright, that's our breakdown of Fidelity's Government Cash Reserves report. What's your take on how these massive cash flows are managed and what it signals about the market? Let us know in the comments. If this deep dive helped you understand this complex financial document, hit that like button and subscribe for more. And don't forget to join our Discord community for more exclusive content and discussions, linked in the description below. Thanks for watching. See you next time.